Three things to think about. First is the short term. You'll probably see a relief rally, right? You've taken out the uncertainty of what will happen. That's going to calm the market down to a degree. Then you think about the long term, and quite frankly, nothing's really changed longer term, right? Fundamentals still remain pretty strong. The economy looks good, but we are late cycle, and it's reasonable to think that you will see lower earnings growth next year, and that might result in more muted equity returns. And then I think the third thing to keep in mind is the personal reaction. I see Joe is reacting very strongly this morning, as many of us are. But if you go back 2 years ago, a lot of people were nervous about what Trump did. And if you got out of the market, you missed really good returns. And so I think we got to focus on the fundamentals, what's really going on in the economy, and put some of the politics aside for the moment when it comes to investing, certainly.
Janelle, I want to get your take, but specifically, you look at what's happened to Treasuries and just even the past couple of hours and what you think the expectation is going to be in terms of what divided government ultimately looks like.
Sure. Yeah, I think if we looked early last night, we actually saw the 10-year move up at one point to 325 before it settled back down to current levels. Going into this cycle this summer, we really took a look and said, what do markets typically do when we see a shift of power from one party to another at the midterm elections? And we observed really that 1 month, 1 year out, we saw rates flat to actually slightly lower, and then risk assets slightly wider. And while we think this was very informative during the summer months, I think we also have to step back and put it into context of what the pricing of these risk assets have done over the last month. And so when we step back and we look at the underperformance of risk assets, many credit spread sectors wider year over year, we actually think the removal of the uncertainty decreases volatility and will be fairly constructive for risk sectors, credit in particular, today.
Right. Different version of uncertainty, and I know Joe thinks I'm beating a dead horse, but I think it's the issue of the morning is actually what Beijing thinks this morning and what that's ultimately going to mean to the negotiations over tariffs and therefore the markets.
Because that will impact growth, right?
Yes.
When you think about next year, if you can't get earnings growth because the tariffs weigh on things, then you could see an environment where equities are actually down if you can't get earnings growth.
But therefore, the answer to the question, which is, or the question rather, and maybe you have an answer, is how you think this changes the dynamic of those negotiations, if it does at all, given that we thought that China was waiting to see whether the president was going to have more or less leverage after today. And I'm not, and it feels like a bit of a jump ball.
Their stance. Yeah, I can't see them changing the way they've been thinking about this just because of change in the House.
Yeah, but Beijing probably not celebrating, right? Probably not thinking we have a much stronger hand, that they have a much stronger hand at this point.
No, but they're obviously thinking much longer term, right? So we're focused now all on 2020. They're thinking 2025, 2030. So I just don't see them changing for a short-term move in power.
Janelle, you have a take on that?
Yeah, I think we would agree. I mean, I think if we look at the third quarter earnings cycle, definitely the impact of higher input and logistics costs weighed on corporates and weighed on corporate outlook. But again, I think it's about stepping back and putting it into context. We see spreads wider, yields are certainly higher year over year, and there has been a benefit of tax reform, and we have seen stronger corporate profitability. So when we step back and think about it in a price for risk context, it seems like there's still a lot of good opportunities in this market in fixed income, and we're not concerned. We're actually more constructive on this repricing that we've seen.